I do want to talk to you about what's going on with the precious metals because, I mean, the run has already been incredible. And now we have this breaking of $5,000. How significant do you think that level was, and what happens now?
Well, first of all, I think the most biggest takeaway from the gold market is that it has been a very reliable mirror in that it shows all the potential cracks. And at 5,000, what it's really saying is, are those cracks going to become more like fissures, right? And so you've mentioned some of the cracks already, obviously geopolitical situation being one. But on the other hand, we also have the silver market, right? And so essentially that gold to silver ratio is showing yet another potential crack that many people aren't talking about, which is, are we going from the prediction of disinflation into more of a super cycle of hyperinflation? Because all of a sudden, even with all the economic growth that's projected, the demand on commodities is also going to continue to grow. So I don't see gold or silver going down. That doesn't mean we can't have a correction. Would I be first buying at 5,000? Probably very expensive to do so. But with predictions of 6,000, 8,000 and beyond, we don't really know. What we do know, this should be a little bit alarming to people about what's going on.
Well, and the flip side of that, and maybe the flip side of the alarm over that, is also the dollar, right? Which is going down. So are we, as we continue to see metals move up, does that definitely mean that we're going to continue to see the dollar move down?
Well, we've certainly seen the metals go up while the dollar was actually trying to consolidate and even have a little bit of a pop. So this recent downward move in the dollar is certainly another concern. We aren't at points yet where we need to start to panic about it, but now DXY just broke down under 97. And there's a lot of different reasons for why the dollar is settling off. I think the biggest concern we have to have, not only our own purchasing power and this whole inflationary potential, but also, what does it mean for our relationships geopolitically with foreign countries who may not necessarily want to support our dollar? And so I think the best way to look at all of this backdrop is we got to look at the glass half full and half empty. And the half full part, Julie, is that everything that's going on with the administration, with the deglobalization and the onshoring and the muscling that we have to get more materials into this country, plus demand that people pay us, or either that or we're going to produce in this country, could be good. But we also know that there's a lot of things that could go wrong. And that's why we're seeing the dollar fall and the metals really continue to have a lot of support. So the question is, what happens to the overall market? That's right now, I think, a little bit under question because the market is strong.
Right. And, the sort of, as all of this stuff has been unfolding really over the past year, whether it's tariff threats or the Greenland situation, most investors who are bulls say to me, earnings are fine, right? And that's really the thing that's going to matter in this market. Is that how you see it also? I mean, especially since we're going into a week that is going to be blockbuster earnings, between large cap tech and just a very busy week for earnings.
Well, I think the earnings, to me, have always been sort of backwards looking in a sense. Because it's reporting what it did in the quarter before. So the question is, what happens in the following quarter? And there's going to be things that are going to affect certain earnings and things that don't affect other companies. Obviously, interest rates, that's going to be a big topic this week with the Fed, is going to be part of it. Economic statistics, consumer confidence, which comes out tomorrow. So the earnings are not necessarily, to me, what's the most important thing. It's going to be the reaction. And I think we can just start with Netflix, right? The earnings were fine, but the reaction was negative. So I think we're going to see that in some of the companies because they're going to be looking at CapEx and how much more money can be spent without the consumer participating in getting those companies to grow. And then I think there'll be other companies that might do well. I think of the earnings coming out this week, I'm mostly interested in Meta and Microsoft, probably somewhat technical, but also because those have not necessarily been participating in the big run that we saw as we were coming into this year, like we saw in some of the other stocks, like Google, for example. So it'll be interesting to see. But the whole tech area is not really been my major focus right now. Anyway, I mean, we own Micron because the memory's gotten hot, but my God, that thing's gone parabolic. I think we're seeing a big shift, rotation in this market right now.
And it's interesting that you talk about that, Mish, because we've seen like little kind of attempts at that rotation over the past year. This one feels more real or sustainable, right? But how will we
Mhm.
know? Is it just a matter of waiting to see if it keeps going? Or are there other sort of technical signs that you can read underlying the market that tell you that this one is a little more here to stay?
Well, first of all, we have seen already small caps outperform this year the NASDAQ. That's a new thing. We haven't seen that before. So we have to really not only see the small caps continue to do well, but we have to see some of those other inside sectors participate in order to keep the small caps going. From an economic standpoint, we have seen durable goods just came out very positive. So we are seeing growth in the US economy. That's what these are all about, right? This rotation is showing an optimism for the economy to continue to grow. Whether that optimism remains, of course, we don't know. But at this point, the also areas we have to look at in terms of where we're rotating is something like biotech, which has been under pressure for a long time. Now, all of a sudden, all these biotech companies are starting to perk up, not all, but many. And even from our own standpoint, where we do a lot of quantitative models off of trend strength indicators, we are rotating out of some retail names and smaller tech names into more biotech names. So this is all very interesting to me. We want to see small caps, IWM stay in the game. We want to see it get back over 267 and not fail the January lows. And if that happens, then we can continue to see that rotation. But again, with all the caveats that the mirror of our dear gold is showing constantly in your mind, you have to be really vigilant this year in terms of your own investing.
Well, and I'm curious if we're talking about rotation, what does that imply for your positioning in big cap tech, right? If the rotation has been sort of out of those into some of these other groups, does that mean you're lightening the big tech you do have? Does it mean you're just kind of staying away from it right now? How are you thinking about that?
Well, we've lightened already. I mean, we came into this year with a lot of different positions. Right now, in terms of the big tech, the only ones that we're holding really is Google, Alphabet, and also Micron. I personally, from a discretionary standpoint, like I said, I'm looking more at the quantum space with Microsoft. And also, I think Meta sort of always gets underappreciated. It has a nice look to it right now. We'll see what the earnings bring. But NVIDIA, we're flat. I mean, the NVIDIA has really kind of done its job. And we saw there was big news today about CoreWeave, and that's probably why it's down a little bit. But Tesla, another one. I mean, these may all have a great future longer term. But if you're just getting in now, this to me would not be the place that's most exciting.
Interesting. All right, take a look at those biotechs maybe instead. Mish, good to see you. Thank you so much. Appreciate it.
Have a warm day, Julie.
Thank you. I will try.
I would like to kick things off here with Meta and Microsoft. We're expected to hear from them. What exactly do you want to hear from Microsoft when it comes to AI-related CapEx spending in order for you to feel confident here about the returns on spending?
Well, I think there's a couple things. I mean, first and foremost, we're going to want to watch their margins to see if they're starting to realize the benefits internally of adopting AI. But we're also going to want to hear about these capacity constraints, because if you remember, Brooke, that's really been one of the big things that has kind of restrained the growth that we've seen in their cloud business as they continue to add more and more capacity for both AI and data center. And with that in mind, it's really going to be paying, I would say, very, very close attention to what they have to say about their remaining performance obligations or backlog. To the extent we see this continue to climb higher, like we saw in the September quarter, I think that can give us some comfort. And it is more likely or not to be just a time between when the business that is in this big backlog number is booked as revenue as that capacity comes on stream.
Now, Chris, we're getting these results this week at a time where investors are a bit fearful about the AI bubble risk here. What differentiates here when you're set to hear from Meta? What should you be listening for in that earnings call?
Well, there too, it's going to be what is their CapEx level. But to me, when we think about Meta, there's really two things we have to focus in on. First and foremost is What is the trend in advertising? Are they continuing to outperform the market? And remember, Brooke, they're on the cusp of really spreading that business model of advertising across Threads and WhatsApp. Tells us that they should be able to pick up more advertising dollars. But the second thing to focus in on here too is going to be their margins. We have seen them continue to lean into AI to really drive not only a better mix of advertising, but also help automate. So that could give them greater productivity. We should see that flow through their margins. That's what I'll be watching for.
Chris, anything you're listening for when it comes to that sort of backup, that reversal of their initiatives around the metaverse?
You know, I have to say, I've always been a little skeptical about that, to the extent that they're leaning a little more into wearables with the glasses, smart glasses. I think that is smart, but I want to hear how are they going to expand that array and bring the price down so it's even more affordable, Brooke.
And when you think about another company that's in focus here, part of the Mag 7 here is Tesla. Now, many on the street are really seeing more of a longer term focus there when it comes to what we heard from Tesla CEO Elon Musk yesterday, or rather last week in Davos, around humanoid robots as well as their robo-taxis. So what will you be listening for there? And how of a long-term mindset should investors have for a company like this?
Well, look, I always think it's important to look, on a rolling 12 to 18 months out, but you can't ignore, the near-term hurdles. So, we have to remember that we're still coming off of the lack now of subsidies for EVs. There are going to be questions about the Cybertruck. If you remember, Musk really promised, 250,000 units. It looks like they've shipped, high single digits of that. So those are some questions. What about the competitive landscape, especially given what's happening in Canada and the bringing in of Chinese EVs? So I agree that autonomous robotics, it's out there. We'll have to see if they can get there, but near term, there are going to be some bumps along the way.
Chris, which one are you playing here? Because we did hear from Tesla bull Dan Ives. He said that he believes Tesla will own about 70% of the global autonomous market over the next decade. Once again, that long-term target. But when you think about Google's Waymo, our Yahoo Finance Prasi Barini has just been reporting on the surge, the advantage that they're having, especially within American cities. They just seem to be ahead. So are you choosing Google or are you choosing Tesla here when it comes to these autonomous vehicle growth?
So there's a lot more players out there than just that, Brooke.
Right.
Amazon with Zoox, you've got NVIDIA with its own investments. Qualcomm is doing some investments as well, partnering with some European car manufacturers. So I would say that I think we're really early in this. When we think about, the path to fully autonomous, it's been pushed out several times. And I think that, you can spread your bets, but the reality is that today, autonomous isn't going to drive a demonstrative part of anybody's business. So I think in the near term, if it's Tesla, you got to focus in on what's happening with EVs. If it's, Google, what's going on, search, advertising, Google Cloud, and AI.
Right. So many different puts and takes when it comes to all these different companies. Another company on the radar for this week is also Apple. And you have your eye on their guidance when it comes to the price and capacity. You say that's a concern there. Walk us through how you're looking at this report.
Well, let's just back up a little bit and think about what we've heard from Micron, SanDisk, and the others about how the demand for AI and data center memory is so strong that they're shifting capacity towards that. We also know memory prices are going higher as a result. What that means is that folks have been ratcheting down their expectations in 2026 for the shipments of smartphones, PCs, tablets, and the like. And when we think about Apple, predominantly its hardware business, well, those are three big areas for them, especially for smartphones. So I do think that Apple will probably have a very good quarter when they report their December results. But it's the guidance, at least in the near term, that I think could weigh on the stock. But Brooke, there have been some developments over the weekend regarding the timing of the next gen Siri, which of course will be AI enabled, backed by Google, that could take some of the pressure off that guidance. I'm of course referring to the fact that this new revamped Siri could be shown possibly as soon as the end of February, shipping in April. And depending on how that comes across, if it delights consumers, that could start to foster the big upgrade cycle that folks have been looking for.
Yeah, Chris, Google Gemini really gaining momentum here as ChatGPT tries to keep up. Also, Apple, worth noting, it has really fallen behind the others within this space, down, or rather up only about 10% over the past year. But I do want to talk about this broadening out that we're seeing. We're seeing CoreWeave move higher this morning, and that's largely because NVIDIA invested $2 billion in CoreWeave to accelerate the build out of a more than 5 gigawatts AI factory by the year 2030. As you see this broadening out, and as you think about this investment that NVIDIA is making within CoreWeave, is that a good play right now?
You know, we play CoreWeave indirectly in the Pro portfolio with our investment in a company called Suro Capital. They're also invested in OpenAI, Whoop, and a bunch of other companies. And I think that's my preferred way to play that, because I can pick up some dividend income as well, given Suro's business development, BDC structure. But if you're not involved there, even though I think it's a better way to play it, a safer way to play it, I wouldn't chase CoreWeave here. I would much rather buy the companies like an NVIDIA, like a Broadcom, like a Marvell, that are kind of the arms merchants shipping chips to all of the rising capacity levels that we see out there.
Odds of another government shutdown have been rising, with Polymarket showing those odds at about 80% as of this morning. Now, odds had been, as you can see from that, have been greatly diminished until the events of this weekend and the killing of Alex Preddy in Minneapolis. Our Ben Werschel, our Washington correspondent, is joining us now with more details on this. So it seemed like we were going to avoid another one of these until what happened this weekend.
Absolutely. Yeah. What the events of this weekend has clearly kind of changed the political calculus here. I agree with you. Last week, we were kind of dismissing the chances of government shutdown. Now it's very much likely, because the bill on the floor this week that the Senate is considering has the Department of Homeland Security funding in it. The Department of Homeland Security is the agency that oversees ICE as well as the Customs and Border Control. So that's the real issue. Chuck Schumer has said Democrats are not going to support it, and a unified Democratic Party can block it unless there's an overhaul of the agency. So that's a major sticking point that's clearly going to be pushed very hard from both sides on this issue. In terms of what a government shutdown would look like, we are in a different place than we were over the last government shutdown, because what would happen this Friday, if there is gridlock through the whole week, is what's called a partial government shutdown. There's 12 appropriations bills that need to pass Congress to fully fund the government. 6 are actually already done and dusted. So they're already set. Those agencies are going to continue no matter what. It's these other 6, the Department of Homeland Security and 5 others. So that's going to lead to kind of mixed economic effects if this goes forward. Government economic data is a big one people watch. The Department of Labor, that oversees the monthly jobs report and things like that. They may shut down. The Department of Commerce, which oversees other economic data, has their funding set and will not shut down. Similarly, the SNAP program, which was a big issue in the last government shutdown, is fully funded until September. So that would continue, food benefits, things like that. Airports, on the other hand, those agencies are up in the air. They would be shut down and would have some potential delays there at the airports from TSA agents and air traffic controllers. So a lot of mixed signals. Washington seems very gridlocked at the moment, and I would agree chances are high. But what this looks like is still being sorted out.
Gotcha. And a lot more complicated this time, it sounds like, in terms of what shuts and what doesn't. Meanwhile, speaking of economic impacts, we're also watching Minneapolis for that reason, because of what's been going on there. And we now have a number of CEOs, a lot of big companies actually based in Minneapolis, and a number of CEOs have signed on to a letter kind of calling for basically things to stop happening. But I guess that too is more complicated.
Absolutely. Yeah. So this is a significant letter, and this is 60 CEOs, and the major names are based in Minnesota and Minneapolis, Target, 3M, companies like that. The language here is pretty limited, I would say. It talks about calling for an immediate de-escalation of tensions and for everyone to work together to find solutions. That's pretty vague. Clearly, they had to kind of negotiate amongst all these CEOs to get language that would be agreed upon. So the effects of that could be pretty limited in terms of the situation on the ground and the immediate question of whether ICE will stay in Minneapolis for the foreseeable future. What it reminded me of, just to tie it to the government shutdown point, is this is very similar statements you're seeing from Senate Republicans at the moment. Essentially, we're unhappy with this. There's a problem here with what's going on in Minneapolis, but we're not calling for anything concrete, especially calling for ICE to leave the state at the moment. So if either of these front shifts, Senate Republicans or CEO leaders like that would be significant and would increase the pressure on the Trump administration to make a real concrete change of what's going on there. But at the moment, they're clearly holding back kind of the amount they could go further.
And then while I have you, Ben, and as you're covering everything that's going on in DC, you're very busy, obviously, by the way, with that. Last week we were talking about Greenland. Now we're talking again about Canada, because after a speech by Mark Carney last week and after some discussions between Canada and China, President Trump is once again threatening some new tariffs on Canada.
Exactly. Yeah. Another weekend tariff threat from the president. I will say that this Canada threat, what we're seeing from the president, the sense I'm getting here in Washington is that it's being downplayed a little bit, partly because there's so many off ramps that are just in evidence here of sort of how this could end. What Trump is threatening is 100% tariffs on Canada over its relationship with China. He's claiming that China is taking over Canada, and he can't stand for that. So he's going to sort of essentially institute 100% tariffs there. What I think is key here is that his threat here is about, when you read his post, it's kind of about a future deal that even Mark Carney says is not in the offing. What China and Canada did do a few weeks back was a kind of limited deal on canola oil, EVs and things like that, which is significant to see these two countries cooperating. But this is not a free trade deal. Mark Carney has said that's not going to happen anytime soon. Trump is clearly trying to preempt any moves in that direction. The overall music here is the USMCA is up for renegotiations this summer. So a lot of this back and forth is clearly kind of setting the stage for that. So we're going to see a lot more of this in the months ahead. I think, although the sense, I think, for market short term is there's a major change here in the next few weeks, although the US-Canada relationship is very clearly up in the air in the year ahead.
So it feels like there's a lot riding, maybe not just on these numbers, but on Tesla execution generally. I mean, the shares have doubled since last April, but they've kind of gone sideways. It kind of tread water since September. So what, in your view, would sort of move the needle more substantially in terms of these numbers?
Yeah, in our view, it's all about risk reward. And given the run up that the stock had really since last April, caused us to go to a sell last fall. We just felt like the risk reward was no longer favorable and in fact unfavorable. So our current price target is $350. If you look back over the last several quarters, Tesla has not had a very good earnings track record. In fact, they've missed on the bottom line in 7 of the past 9 quarters. So I think what you're seeing with the shares, both today and leading up to this release last week, ahead on Wednesday, is there's really a lot of caution. We know Tesla's earnings were down 31% year over year in the first 3 quarters of last year, and now they're getting ready to report the fourth quarter, the first quarter in which the U.S. EV market was no longer subsidized by federal EV tax credits. So we're expecting a more substantial year-over-year drop in earnings. If you look at consensus, they're expecting earnings to be down 38% year-over-year. And, we think that earnings, really this earnings malaise is going to carry over into 2026, which is our primary concern. It's just the disconnect between what the stock price has done over the last several months and the earnings trajectory that we see in the coming quarters.
So, and in your view, is that elimination of those tax credits sort of twofold? On the one hand, maybe reduced demand for Tesla vehicles. On the other hand, they sold those tax credits, right? Or and that was a source of revenue for them too. So what sort of combined effect, how should we be looking at that?
Sure. So we know exactly what Tesla's vehicle sales were in the fourth quarter. They reported that in early January, and their sales were down 16% year over year. But our bigger concern with Tesla is just the sale of these regulatory emissions credits under CAFE standards of the U.S. government, and that's been a very fast-growing, high-margin revenue stream for the company in recent years. And essentially, that market largely went away overnight with the signing of the One Big Beautiful Bill Act, because CAFE standards were no longer enforced. And so these emissions credits, which Tesla would sell to other automakers, which didn't have as much EV exposure, was a very profitable source of revenue and earnings for the company. And so that largely will go away. And that's going to really affect Tesla's bottom line, in our opinion. So, and then, you look at 2026, and this is a year where Tesla really has a lot to prove from an execution standpoint. They've promised volume production of the Cybercab, the Semi, and the Megapack 3 this year. And so, it's a big year from an execution standpoint. And we think, the management really has a lot to prove here.
And on that front, what is your outlook for robotaxis? I think Morgan Stanley sees 1,000 of them on the road by the end of this year. Is that reasonable?
Our outlook is it's a very impressive technology, but that the rollout is going to be a lot slower than what management is forecasting to. Already, since they went live in Austin in June of last year, the rollout has been much slower than what they had promised. So we think that will continue. Even last week, when they announced that they've gone fully unsupervised in Austin, it turns out that the Tesla vehicles were being followed with other Tesla vehicles, which did have a driver. So that wasn't really true, and we just think the rollout to other markets is going to be a lot slower than expected. Based on our channel checks in other states like Nevada, they're well behind in terms of filing the necessary paperwork, in terms of getting permitting. And so we think it's going to be much slower than what they're expecting, which is a big risk.
So we spent all of our time talking about Tesla, not surprisingly. I got to ask you a question about GM, though, too, because it reports tomorrow morning. There you have a hold equivalent rating. And, it feels like both Ford and GM have really been struggling to just correct their trajectories right now. So what does GM need to do? How do they need to deliver?
Well, GM has had a great run. You look back, they've beat on the bottom line for 13 straight quarters. The stock was the best performing auto manufacturer last year. GM shares were up 54%. And compare that to Tesla, which Tesla shares were up only 11% last year. So it's had a great run. This was one of our top picks in 2025, and we just went to a hold on valuation in mid-December. So many things have gone right for GM. They've grown their market share in the U.S. significantly over the last 3 to 4 years. But really, it's their large EV exposure which gives us some pause here, and was really the reason why we head to the sideline. They've become the second largest company seller of EVs in the United States in recent years. And we've seen where they've already taken some write-downs related to their significant EV assets and investments that they've made. And while EVs have been a major growth driver for the company in recent years, we think there's going to be a reversal of that, where they're actually going to lose some market share this year, due to the EV tax credit expiring. So we're a little more cautious. And again, it was a risk reward call. The stock had a big run up, and we just no longer saw a favorable risk reward, a risk reward that really appears more balanced here in our view.
When we're looking at kind of the setup into Apple's earnings, does it feel like because this stock has been languishing a little bit, that the bar is lower, or do you think it still has a lot of work to do to convince investors?
Like you said, the stock's underperformed. It's underperformed year to date. It underperformed last year, but expectations are actually reasonably high We do think the setup is reasonable. We're in line with consensus. Consensus is looking for, iPhone growth of almost 14%. It's one of Apple's strongest growth quarters that we've had. One of the things that we're more concerned about, though, is what the guidance looks like, especially as we're looking out in the second half of the year. And, the other thing that I think people are focused in on is just the rising component costs, things such as memory prices that keep going up pretty much on a daily basis.
So do you expect then the margins to be affected? I mean, Apple's kind of known for some pretty healthy margins.
Definitely in the second half of the year, Apple's probably going to be in a position where they're going to need to take a price increase on the iPhone, where I think people are concerned about the impact that could have on demand. And if they don't take a price increase on the iPhone, I think you'd have more concerns about margins to that point.
Gotcha. Interesting. So we'll watch for that potential price increase. In terms of the backward-looking quarter, Apple rolled out the new iPhone Air, and there's been some chatter that people weren't too excited about that one. I'm curious how you think it's going to do and how that's going to show up in the numbers.
Yeah, from our perspective, the Air is not selling well. That's not going to be the driver for the quarter. What we really see is the driver for the quarter, and you're going to have pretty strong unit sales for Apple, but the driver for the quarter is going to be what it's been for the last couple of years, really strong Pro and Pro Max sales. And what that's going to mean for Apple is stronger mix towards higher average selling prices. And so you'll see ASPs up along with unit sales, but the Air was not necessarily a driver for the quarter at all.
Gotcha. Let's also talk about some of the other overhangs for the company that maybe we'll get some updates on, right? And some of that has to do with Siri, has to do with AI, and now the company is partnering with Google. What questions do you have for them around how that's all going to work?
Yeah, I think the key question for us is how is Apple going to monetize AI? They're also utilizing a competitor's technology. So I think those are really key questions. When Apple initially announced Apple Intelligence, a lot of the promises that they told us they would come out with were not there. And then they delayed the rollout. So what we'll really be listening for are what key integrations are coming. I think what people want to see is deep integration with Siri, with other applications that you can use on your iPhone. That's really the key question. And then beyond that, one of the things that we were excited about last year is whether or not AI will drive a hardware upgrade cycle, get people that have older devices to really want to upgrade their phone. That's really the key question. So, can they integrate this technology, whether or not it's theirs, doesn't really matter. As long as it can drive some type of hardware cycle, those would really be the key focus items.
Well, and that kind of brings up the question I've had about the AI integration into the phone, which is whether it's a push or a pull. In other words, is this something that users want? Many of them are probably already using ChatGPT or Claude or what have you on the phone. So, is it just a matter of that Apple has to have it to drive that upgrade cycle that you're talking about?
Well, again, that's the question, is how deeply can Apple integrate Gemini into Siri, where Siri can then control the different applications on your phone, where Siri could then go book a flight for you or schedule a restaurant reservation for you without you having to actually do anything. That's the key question of how deeply Apple can integrate it. And then whether or not they can actually monetize it. Some of the research that we've done, consumer surveys, really suggests that consumers are not interested in paying for something like that, but that would just deepen, Apple's integration into consumers' lives, and I think make, their technology more indispensable. So I think consumers would end up using that, but the key for Apple, I guess, again, would be keeping people within their ecosystem, utilizing their products, and ultimately they'd sell more smartphones.
And Brandon, you've got a sector weight rating here, hold equivalent rating. What would you be looking from them to change your mind on that?
I think we'd want to see, expectations in terms of where growth expectations are really come down. From our perspective, growth expectations for iPhone are really like up and to the right for the next couple of years. That's pretty lofty expectations for a company that is in a much more mature business and generally more cyclical. So we'd want to see expectations come down and or the valuation move lower. Apple's not inexpensive. It trades at roughly 22 times EBITDA. That's higher than it's been historically. So we'd want to be picking up the stock when expectations are much lower and or the stock is trading at below its historical average.
I just want to touch on the potential for a shutdown, first of all. As we just heard from our Ben Werschel, this one, unlike the one that we saw late last year, because it's a partial shutdown, but still, are you now starting to handicap a potential economic effect from that?
Yeah, so I think being partial, it makes a big difference. Obviously, there's still a lot of big agencies left to be funded, but the drag coming from kind of the economic calculation, the furlough of workers would be more modest than what we saw in the fourth quarter were this to occur. And I think, more importantly from my seat where I am as an economist, what I'm most worried about is probably the data, because we're still recovering from some of this missing data. So not having the Bureau of Labor Statistics be able to publish employment data, inflation data, while they're still kind of catching up to the effects of the previous shutdown, well, I think that will cause more of a disruption, both to markets, but also for economists, for the Fed, for policymakers as well. So I think that's a big risk, and we'll have to see how things play out this week when it comes to the votes.
Stephen, I'm curious also, because I'm home in New Jersey today broadcasting because the Jersey Transit was not running today. I'm curious, when you see a big storm, the scope of which we haven't seen for quite some time, how much of an impact does that have on economic growth? Or is it something that's sort of just like it was with the shutdown, maybe a little bit delayed or displaced?
Well, that's a great question. And I'm in the office, as you can see today. So at least some of us have been able to make it in, but, we're all kind of fighting the weather. I'm one of four, I think, here in this office, so not many. And we actually were able to look at a previous storm in 2021 and see how that affected consumer spending, both our data and the official data. And you do see that these major storms can be a drag, and they tend to get made up in subsequent quarters because that spending is going to happen at some point or the other. But there is some loss activity, right? You're going to have some flights that are canceled that don't come back online. You'll have stores that are shut for the day, and maybe they're not making up that business, so to speak. So there is some loss of activity. It's relatively modest, I think, in terms of net loss, but you could see a drag in the first quarter and then maybe a boost in 2Q as you get kind of that mechanical rebound, similar to the shutdown.
Gotcha. Only 4 people in the office. Wow. I guess you got a lot of commuters there at B of A also. Let's talk about the Federal Reserve meeting this week. We all are assuming there's not going to be any change to rates. So if that's the case, what are you really going to be focusing on here? Is it going to be sort of the political questions that Jay Powell is likely to get during the presser? Is it going to be dissent? What do you think?
Yeah, I think of the things, obviously we're going to be parsing the statement as we always do. We'll be parsing the presser. I think you make a good point in saying that the presser is probably going to revolve around political questions and not necessarily forward guidance. So we won't get too much from that this time, but I do think dissents will matter because you're going to start to see, how are things positioned on the committee heading into the post-Powell Fed. When we get a new Fed chair, and that could happen any week now. Obviously, we've seen betting markets move around about who people expect to be the next Fed chair. But we'll see with dissents, is the committee still biased towards cutting? Is that still that firm camp? Obviously, Governor Myron is very likely to dissent. But then what about the hawks? Because there are several hawks on the committee who probably weren't too on board with cutting rates in December. And maybe they use this opportunity to maybe issue a dissent too. So I think you're looking at dissents, you're looking probably at the minutes in 3 weeks for really where the debate is, where the consensus is, how dispersed are the views on the committee. So we may not get that much information today, but maybe the dissents will give us some information. Maybe we'll learn more in 3 weeks from now when we get the minutes, though.
And as you mentioned, we might be getting an announcement of the next Fed chair this week. And, the odds markets have just swung wildly with Rick Reeder now on top. He was somebody that a lot of people had sort of discounted entirely for much of this discussion. I mean, at this point, how important is it which of these individuals it's going to be? I mean, is the outlook for rates going to move that much depending on who it is?
I think the short answer is probably not. They're probably all supported of cutting rates more than maybe the current Fed led by Powell is, and cutting rates, relatively quickly to say a 3% level. So you've heard that from Kevin Hassett, you've heard it from Kevin Warsh, you've heard it from Rick Reeder, even from Governor Waller, right, who's still kind of in the running. So I don't think in terms of the general dynamic, it doesn't change all that much in terms of direction of policy. Where you could see some differences emerge is maybe on reforming the Fed, on regulatory policy, on balance sheet policy. It's some more nuances, but I think the path for rates between the four of these candidates is not looking all that different. And then what I'll stress as well is they're just one vote. And, the composition of the Fed may not change all that much other than getting a new Fed chair. So it's really going to depend on what the committee's read of the economic conditions is, and how do you get a majority view in terms of setting policy rates. And that's really going to always come down to economic fundamentals, economic activity, inflation, the labor market. So we'll have to see how things play out this year.
We will. Stephen, thanks a lot. Appreciate it. Elon Musk saying last week in Davos that he expects to be selling Optimus robots by the end of 2027. Of course, those are humanoid robots, and we seem to be entering this sort of hype cycle for robotics. So let's get it down to reality and talk about what is happening actually now in terms of the robotics space. We're joined by Jake Lucasarian, Gecko Robotics CEO. The company makes robots, but not humanoid ones, Jake. And so I wanted to catch up with you because we have had all of this talk about humanoids, and yet most of what's happening actually concretely in the industry right now is making robots that don't look like humans. So talk to us about what you guys are working on these days and kind of how you're thinking about that sort of public hype cycle around humanoids.
Yeah, thanks for having me on. I was out there in Davos hearing so much about the excitement about robotics. I think what's interesting is, when you get down to the hype of AI and artificial intelligence, what you begin to realize is you interrogate the information, data sets, and actions that go on, especially in these like physical worlds and sectors, and you realize that there's actually a fair amount missing as it relates to the infrastructure that can power such the gains in the ROI for AI. And so a lot of the CEOs that I talked to in the energy, manufacturing, and then the folks in decision makers in the military, they're very much interrogating, okay, where's all the information, data, and gains and ROI that we been promised. And so this is why there's such a boom and a focus on robots, is because they help to fill this huge data gap and an action gap that exists in the real world where ROI is created.
And so, when we're showing some of the footage of Gecko's robots, and so what you're talking about is less like a robot that will do things for you, although there is some of that, and more of a data gathering device, to your point, sort of being able to map in AI what exists in the physical world, right?
Yeah, that's right. I think one of the things to really drive home the point of, look, I started this company 13 years ago before robots and all the sectors that we're talking about were cool and kosher to talk about, especially from Silicon Valley. And so what we began to realize back 13 years ago was that the information, the actions, the things that in the real world that can really drive transformational change for businesses is actually focusing on the business outcomes, whether it's creating kilowatts, refining petroleum or hydrocarbons, or it's getting ships out of dry dock faster to deter conflict around the world. And so this is the thing that we wanted to focus and wanted to create a vision for robotics to be able to pave the way to create these incredible gains and change the way that these businesses can actually run, decisions they can actually create and make, and actually do it as well safer and in an environment that allows for you to get the most ROI possible, with both these droids that you see here and then also the humanoids that are coming. But the thing that's missing and has been missing has been a universe and a platform software-wise where all the information and data can go. And that's why we had to make Cantilever, which is what we sell to our customers.
Gotcha. In addition to the robots that are gathering the info. Now, are you guys developing a humanoid as well? Or is it a matter of that when humanoids get developed, they'll be able to, sort of upload the data they collect into your system?
We are creating the infrastructure and the nervous system for those humanoids to be able to actually be as impactful as possible. I mean, what's so cool and so interesting when we see these humanoids, we see ourselves in them, right? We're like, we're creating these generalized robots that we want to be able to take on some of the tasks that we don't like to do, folding laundry or making food or cleaning dishes. What we don't talk about is there actually a ROI to that? Am I going to spend a bunch of money, to be able to have a robot do that? And the reality is most likely not. And so the question is actually, how do you employ robotics to actually drive massive amounts of ROI? And you have to create a structure, a platform where all the information data sets, for robots can go to. And the most ROI you can create is actually in the sectors that I was mentioning, like the energy sector, the Department of War, these manufacturing sectors, these 30 jobs that actually drive GDP. And so, that's what the robots that we focus on building are oriented towards. And then we kind of want to see the value that humanoids and mobile robots can bring, because I can tell you something. It's there's not as much value. These like walking and these walking around robots aren't exactly the most impactful as it relates to changing the way that these companies and these sectors operate and work. They will. But the key is to focus on the kinds of tasks, the kinds of information that can drive the kinds of decisions that weren't possible before and can actually have high ROI. Everybody's focusing on this question right now because they have to be able to justify all this investment into infrastructure and technology. And they know that this will be the differentiator, for these companies in the next 5 or 10 years. It's going to completely upend, who is the dominant players. Like in the Middle East, for example, I was just there for ADIPAC and UAE and Abu Dhabi, and I got to see firsthand, some of the aggressive moves that CEOs like Dr. Sultan Al Jaber is taking, because of the core belief that this will fundamentally change the chessboard as it relates to the global economy. And so, those that adopt quickly are going to dominate the next 5 or 10 years.
Jake, before I let you go, I have to ask, because you guys are private, if there is any update on an IPO for you all or how you're thinking about that.
Yeah, the IPO will be. What's exciting is that as the acceleration, there's so much tailwind in the robotics and energy sectors right now, which beginning to get more and more tempting to do so earlier. But I won't comment on that right now. We're really focused on delivering all this impact, and because of the technology gains and the adoption from our customers, my goodness, there's a mad rush to hire a bunch of people right now and just deliver incredible 8-9 figure results for these customers. And so that scaling that is what I'm focused on right now.